Let's get more analysis on this budget that was handing down last night. Go beyond all the spin and figures with business editor Ross Greenwood. First off, Ross, the market reaction, because we're locked down here in case we can somehow get a tidbit out there and make a fortune on the stock exchange.
Well, that's right.
Would that have been possible?
It wouldn't have been possible, really, because the markets didn't really move all that much off the back of this. I think much of the forecasting in here, and remember it is forecasting, really was as expected. And so from that point of view, when you look around the place right now, what you can see is, say, for example, if we go to the 2-year bond yields, I think this will be a pretty instructive way to look at it. Short-term interest rates, what do money markets say right now? You can see here now, 3.24% there, a tick higher than what they were before it came out. And the interesting thing about this is about the inflation forecast, I think, Tom. And I think it really goes to the heart of whether the market and whether a lot of observers are thinking that the government and the Treasury have got it right. If we go a little bit further, you can see the Aussie dollar at the moment. In fact, these are the longer term over the past 3 months. That's what's happened to those rates. Have a look at the Aussie dollar. It's still bouncing around that 67.5 US cent mark, 67.3 as we speak. And even then you go to the stock market and where it's expected to land today. So the share price index of Australian markets today, after the Wall Street market was lower overnight, down by about 0.3%. So the reality is, Tom, that there's really not much in all of that in regards to the markets and a violent reaction to this budget. So in many ways, the forecasts in there have not surprised the market observers.
So the question that's going to be the most hotly debated around contributing to inflation, interest rates would be going up. If this budget was going to be something that smashed inflation, we'd go and get these big spikes in interest rate predictions. Is that right? And what can we read so far from what we've seen on that?
You can read a couple of things. One is just the way in which the markets have interpreted the reactions in there. So if we have a quick look at some of the forecasts inside the budget itself about interest rates, because they tell us, right? They basically say that the market is tipping that the cash rate is going to fall from 3.85% in early 2024. So really not much more in the way of, sort of interest rate rises from now until then. And then it's going to fall over the following year and to 3%. Now, that is on the scenario that the inflation rate actually starts to fall back to where the government and the Reserve Bank would like it to, into that 2 to 3% band. Now, I will say that Standard & Poor's this morning has come out with its own report, S&P Global Ratings. While they've confirmed Australia's credit rating, they do say we expect inflation to be stubbornly higher than the Reserve Bank of Australia's target until fiscal 2026.
Okay.
Now, that's really important to see that, because this goes to the heart of whether you can believe what's in this budget and what comes in regards to deficits, in regards to the spending ability of the government into the future, in regards to the debt of the country, because if inflation stays higher, the interest bill is higher, and as a result, the government really has less room to be able to make these big spending predictions that many people want, and indeed to absorb the costs that it's got coming down the line from NDIS, health, and the defence as well.
So it's one ratings agency, and that differs from their previous view on inflation? Is that a sort of...
Not really,
okay.
But the fact is they've just confirmed it. But that's what they're saying out of last night's budget, looking at those latest forecasts from Treasury and saying, look, we don't think they're right. Fitch has come to a similar view. They've again reconfirmed Australia's AAA credit rating. The only thing that can really knock us off balance in regards to the AAA credit rating would be, say, for example, some sort of commodities washout or a big global downturn. And that's certainly not predicted by Treasury, not predicted by any of these ratings agencies either.
And the total debt we're carrying is basically getting a lot less. So
that's right, yes.
That. Finally, on forecasts, one budget surplus. And maybe the government wants to play hero again in a year and go, look, we've pulled another rabbit out of the hat?
Well, if you think about any budget, when you go into a budget, you don't forecast and basically throw everything at the wall, do you? You basically do something that's conservative. And we've seen that over the years, particularly with commodity price forecasts. So this is the budget outlook. Here's the surplus here. But just have a look at that second year, 2023-24. They're forecasting a budget deficit of just $14 billion. And we've seen this year just how quickly that can turn around if commodity commodity prices are higher, if the unemployment rate basically doesn't rise as much as anticipated.
Because they're already saying it goes to 4.5. So your point on that
That's
is
right.
it can go up, but up by not as much.
Yes, that's right.
Result.
If it goes to 4%, let's say, then they're pretty much back in surplus next year. And I've got to say, that would be, if you like, a pretty heroic thing for a Labor Treasurer, the first since 1989, to produce a surplus, to be able to do it again and again take pressure off the borrowing, take pressure off the interest rates that are going to be paid by this government in the future.
Yeah.
Now, also, it basically helps Australia if there is any sort of economic downturn. It puts us in better comparative shape than most countries around the world, because do remember, a budget is a set of forecasts, and as we know, with commodity prices, they can be right and they can be wrong.
They're usually wrong.
They're usually wrong. That's true to say.
Ross, thanks.